Great to see you today, Greg.
It's a pleasure, Aaron. A little introduction here. I've been in money management. I've been a technical analyst since the early 70s, and I've been everything. I've been a newbie, I've been a hobbyist, I've been an author, and I think probably in the last 20 years, I would say I'm a practitioner. I actually managed money. John Murphy and I started a money management company in the late 90s. We sold it to a company in Athens, Georgia, named PMFM, later named Stadion. We used a trend-following, rules-based model that I created for them decades ago, and I still use it. Once the portfolio management department filled up, we had a sales force all over the country, wholesalers, and we were going into the UBS and Wells Fargo and Merrill Lynch and Mutual of Omaha and Lincoln and all these and talking to advisors about our mutual funds. And after the salesmen were in there giving them the bullet points that they're given, most advisors did not want to talk to a salesman anymore. They wanted to talk to a portfolio manager because they had very deeper probing questions that most of the sales folks couldn't answer. And so there were just a couple of us in the department that could go out and give presentations. So I volunteered to become a salesman. And I'd been the chief investment officer and the chairman of the investment committee and all that. I still was, but so I started traveling with wholesalers and selling them on technical analysis, selling them on trend following. And I found it very difficult to do because these guys had been around a while. They'd grown up and lived in the world of modern finance, and they'd heard that technical analysis was a black art. It was alchemy, and they just had a bad rap, as Wall Street has done for decades. I realized that I had to change the approach, and I'm not sure when the light came on, but what I found out worked was I started telling them what was wrong with what they actually believed in. And that's kind of the type of presentation I'm going to show today. It's a presentation that I used to these advisors to convince them that modern finance is horribly flawed and a technical approach is considerably better. In other words, I was out there selling TA. And the reason I do this for your viewers is I think many times technical analysts have a difficult time explaining what it is they do to their friends, their neighbors, their families, etc. And this will give you some information and hopefully help you combat that in the future. So I'm going to give this presentation, but I'm also going to explain why I'm doing it, when I'm doing it to the viewers here. So I start out by, I want them to be convinced that they have believed things in their life that just might not be true. For instance, I call it believable information. George Washington cut down a cherry tree. We all heard that story when we were young. George's father caught him and said, "George, did you cut down the cherry tree?" And young George said, "Father, I cannot tell a lie." Well, what a fabulous story. Here's the founding father of our country who could not tell a lie. The problem is it isn't true. It was a story made up by Mason Weems Locke in the 1820s when he was writing a biography on Washington, trying to humanize him. Another thing, along as we're talking about George, is that there was an old saying that George threw a silver dollar across the Potomac. Well, if you've ever been to Mount Vernon, the Potomac River is about a mile wide there. And of course, I get challenged on that, and they say, "Well, it didn't say he threw it across it at Mount Vernon." I said, "Well, they didn't have silver dollars back then either." Bath water runs faster at the end out of a tub or a tank, and that's a optical illusion, because when it's first beginning, you don't see the water swirling or anything, and at the end, when it's swirling, it gives you the opinion it's going down faster, and it's actually going down slower. Some of these are a little strange because I've got 100 of them, but I'm trying to cover all aspects: science, humanities, etc. Dogs sweat through their tongues. Dogs don't sweat. Another one I do is December 21st in the Northern Hemisphere. Most people will tell you that's the shortest day of the year. It is the shortest period of daylight, but because of Kepler's second law of planetary motion, it's actually the longest astronomical day. And I could talk for another 30 minutes about that, but I won't. So the purpose of that was, hopefully, when I cover enough of them, was that the advisor listening to that said, you know, I always believed that story about George Washington, and I sure didn't know that December 21st was the longest astronomical day. So I've thrown them off, and that was the purpose of that part. So there's other types of believable information that is involved with the stock market and with investing. So I'll go through these very quickly, and you just click them as you go. Buy and hold is the only way to be successful in the market. Dollar cost averaging is a good technique. Diversification will protect you from bear markets. Compounding is the eighth wonder of the world. I'll talk about that right now. Albert Einstein is attributed with saying that. He when you look it up, he actually said a few things else, a few other things in addition to that to add to it. But I say that he left out an adjective. Positive compounding is the eighth wonder of the world. You start throwing in a few negative years and things don't do too well. You must remain invested at all times. You'll miss the 10 best days of the year. I'm going to show you a chart of that. Average returns are never better than compounded returns. Probability and risk are the same thing. We'll talk about that quite a bit. Equity asset allocation will protect you from bear markets. Economists are good at predicting the market. I don't know if you watch the cartoon. I'm sorry, CNBC. But they are constantly parading economists on the show and asking them what they think of the stock market. And here's the problem I have with that. The stock market, the S&P 500, is one of the components of the index of leading indicators for the economy. So it seems like they got the cart and the horse reversed when they're asking an economist about the market. Chasing performance is a common technique. That is very true, and it's a very bad technique. So I've got this, the late Mack Evette, he gave me this slide about 20 years. Ian wrote Deliberations newsletter out of Toronto. He died here a few years ago, and this is one of his slides he used. And I think I don't even have to say anything. You just need to look at it for a second. Modern finance wants you to believe that risk is volatility, and that volatility is defined by a statistical term called standard deviation, which is the distribution of returns over time. I think that's terrible that they use that as risk. I think actual drawdown is risk. In other words, the amount that prices have gone down from a previous high in percentages. A client will understand if he's down 50% what risk is, a lot more than if you told him his standard deviation was 31. As you can see, there are a lot of drawdowns. This is the Dow back to 1960, and that red line shows the percentage of drawdown. And what you can see there about 1973 at the top, it was almost 11 years, 1983, before it got back up to that red line again. So we were in a state of drawdown all of that time, and it got down to minus 45% there in 1974. So it's not just the drop in magnitude, it's also the duration. This drawdown went down 45%, but it took almost 11 years to get back to even. This is just a chart I have in my book, Investing in the Trend. Bear markets can be expected because we've had a bunch of them. These are the ones on the Dow back to 1885. I don't use the Dow very often, except because we have actual daily data back to 1885. The S&P only goes back to 1927. And we've had 15 bear markets, and you can see all the data associated with it, decline in days, etc. Even if you left out 1929, that top one, you can see that the average drawdown is 20, 18, 22. I mean, they're all huge drawdowns, and those drawdowns can be devastating if you're a buy-hold investor. So what that shows is that a 42% decline requires a 72% gain to break even. That's called equivalent return math. I think everybody knows if you go down 50%, you've got to double your money to get back to even. And I always ask people, when's the last time you doubled your money? So all the purpose of this is trying to get people to use a technical approach where most good technical approaches, especially trend following, you can avoid those horrible, devastating bear markets. You'll have some whipsaws along the way. I'd say whipsaws are frustrating. Bear markets can be devastating. And this just shows some more data on there. That top gray line is all the bear markets. The average duration is 1,730 days. The total duration in months and the percentage of time spent in drawdowns. Most people don't know this. When you're in a state of drawdown, and especially the ones that involved actual bear markets, they took up 73% of the entire time of the market. Here's the Dow Industrials. These are the annual returns up until, I haven't updated the slide in a while, but it doesn't change the message. The red are the down years, the green are the up years, and they're allocated. This distribution is based on deciles every 10%. And you can see that clearly it was up 2/3 of the time. And if I was selling you a buy and hold strategy or wanting you to be invested in an index fund all the time, I'd say, look, the market is up 2/3 of the time. And this slide is a good one because I tell a little story. I said, let's play a game now. First of all, it's a fair game. It's an honest game. It'll cost you $10 to play. You can play it as many times as you want. And if you win this game, you'll get $1 million. The honest mathematical probability of winning is 1 time out of 6, and there are no tricks. And I'm usually at an audience. I say, how many want to play? And the hands go up everywhere. Mm-hmm. And I say, it's Russian roulette. How many want to play now? Well, there's always a wise guy that raises his hand, but most people are not raising their hand again because they don't want to play Russian roulette, because I've changed their focus from these goofy statistics to the risk of playing the game. And the risk of playing the game in Russian roulette is death. Here's a slide I did on Wall Street. Wants to always have you be invested all the time. And they say, well, if you miss the 10 best days of the year, you're just going to have devastating performance. And you will. That's that red line down there. And I say, well, first of all, that's a hypothetical situation. You can't begin to do that. And you can't begin to do the one I'm going to show you. But what if you missed the 10 worst days of the year? That's that blue line at the top. So what I'm doing is I'm just kind of turning their little sales pitch around on their face at them. And then the other 2 lines are buy and hold, and one of them is missing the 10 best and the 10 worst, which is basically the same as buy and hold. So what I'm doing is I'm taking something they used as a sales piece and throwing it back at them. Oh, this is it going back. This is extreme here. This is the same chart, but I go back to 1926 using daily data. Diversification. First of all, most of us for years have always thought of diversification as a free lunch. Yes, you should be diversified. You should not put all your eggs in one basket. Gerald Loeb, a very famous guy back in the 50s and 60s, he said, well, he said, you can put a few eggs in that basket. Just make sure you watch that basket very close. Well, that's what you can do with technical analysis. You can watch that basket really close. But if you are not diversified, you're just putting yourself at a little bit greater risk, especially if you're just buying stocks, common stocks. So here's an example showing you all these asset classes. These are all Vanguard mutual funds, small cap, large cap, small values, emerging, European, etc. And you can see they're very well diversified. Here are those same mutual funds during the last bear market that we had, which was a bear market that included almost everything. This is why diversification will not protect you from bear markets. It'll just cause you to suffer along with everybody else while you thought you were protected. Compounding is the 8th one of the world. We talked about that. This is an example just where you have 3 years of investments. The boring one is up 10%, up 6%, up 8%. The highfalutin one is up 36%. Of course, everybody's chasing performance, running to that one. Then it's up 8%, and then whoa, you're down 20%. Down 20% isn't horrible, but it's a lot. And you can see they averaged over 3 years 8%. But if you look at the compounded return or the growth of $100, you can see that the good old steady positive return investment did better than the highfalutin 36 and minus 21 did. And then the compound return is +8 for the safer one and only +5.4 for the high volatility one. So I talk about statistics. I think statistics are a wonderful way to learn about the markets, learn how they have performed in the past. I don't think you can use them at all going forward. And I'll give you an example. So we've all heard the story, sell in May and go away. What that means is you sell your portfolio in May and buy back in November. In other words, you're out of the market for 6 months. Well, one of the problems with that is they don't tell you when to sell in May. I mean, there's 21 trading days and there's 6.5 hours of trading a day. I mean, you can sell in a few seconds. So they don't even tell you when you're buying back in November. So, and I don't know what they use for that. Probably the end of the month data, which is terrible. But let's say you did some research and you went back and studied the best day of the month in May to sell and the best day in November to buy. And this worked 75% of the time, which means 75% of the time, and we're not talking about how much you made, but 75% of the time, this strategy had a positive return. And we'll just leave it at that. That's not bad. So let's say you started using this strategy because you were convinced now these statistics are going to play out over time. You sell in May, you buy back in November, and at the end of the first year, gosh, you lost money. You say, well, I'll stick with it. That's one of the bad years. Well, what if you go 3 or 4 years and they're all down periods? The reason you're not going to stick, first of all, you're not going to stick with it because you believe it doesn't work anymore. It still works, but you can't do this for 100 years. So you won't stick with this because it works. What you forgot to remember, did I say that? Yeah. What you forgot was that something that works 75% of the time is wrong 25% of the time. And you forgot about that 25% of the time it's wrong. And it doesn't say there every other year. They could come 3 or 4 years in a row. Modern portfolio theory, first of all, the beliefs of modern finance as started by Mack Evette back in 1952 is that investors are rational. Now, I want to tell you something. If you think investors are rational, you haven't been paying attention. Returns are random. Well, they love the randomness because that supports using statistics and normal distributions to define everything. And the returns are normally distributed. Well, they're not. Gaussian statistics is appropriate for use in finance investing. It is not. Alpha and beta, which we all talk about, alpha is the gains above a risk-free, and the beta is pretty much the volatility or independent of correlation. Volatility is risk. I've already talked about that. They're talking about volatility as defined by standard deviation. I think drawdown is risk. And this is something that always, I don't look at earnings ever because I have this model I follow, which is kind of nice. I don't have to pay attention to anything. Wall Street is focused on forward earning estimates by the analysts. These analysts are very highly paid and they're probably wooed by the companies. I wouldn't want to insinuate that they are, but I wouldn't doubt it. And so if you compare their earnings estimates with the actual reported earnings later, you'll find out that they're just horribly off a large percentage of the time. So modern portfolio forgot that people trade and invest using different time horizons. Some people are day traders. Some people are long-term investors. I'm a model follower. The model tells me when to get in, and it tells me when to get out. And sometimes it's short term, sometimes it's medium term, sometimes. Plus, everybody has different views about the markets. Traders, investors all have different, completely and opposing views about what's going to happen in the market. And the other thing is using different stock prices, weekly, monthly, yearly. So Harry Mack Evette, his modern portfolio theory, which is kind of the big picture of all the stuff, It assumes that investors totally agree on return, risk, and correlations of all assets and invest accordingly. So you can see what's wrong with a theory that thinks like that. There can't be anything positive about that theory if you think investors all think alike at the same time. If they did, the markets wouldn't work. This just shows some of the statistics. I was on Financial News Network a lot in the 80s, and I was watching Bill Griffith and John Bollinger on October 19th, 1987, and we had a 22 standard deviation decline. The odds of that happening are astronomical. You can look down there on line 22 sigma. One time out of every 9 times 10 to the 103rd. All the stars in the universe don't come close to that number. That's an insanely giant number. And so the reason I show this is to show you how inept and how wrong it is to use Gaussian statistics to help you analyze the markets, because we had a 22 sigma day. Oh, this is just where I tried to put it in perspective. It's hard to put 10 to the 103rd. I talk about the speed of light. Then I did the speed of light in miles per hour. Then I did the speed of light per year, and equal to giant number. And so in scientific notation, it was only 5.8 times 10 to the 12th, or about 8 sigma. And October 19th was a 22 sigma event, just to show you how out of range and how out of whack that is with statistics. Risk and uncertainty. These are, a lot of people think these are synonymous. They are not. Risk can be measured. Risk can be measured. Uncertainty cannot be measured. Back when I was an aerospace engineer at the University of Texas in the late 60s, we had some statistics courses, and we talked about taking a jar. Well, actually, we didn't call it a jar back then. We called it an urn. That's how old that is. Took a jar. We put 5 red balls and 5 blue balls in a jar. And you said you blindly picked out a ball. What are the odds of picking out a red ball? Well, that's real simple. There are 5 red balls in there, and there are 10 balls total. So it's 5 divided by 10, or there's a 50% chance of pulling out a red ball. That's risk. That's a risk calculation. It's a mathematical calculation. So the next part is, what if you were not told how many red balls or blue balls were in the jar? What are the odds of picking out a red ball? There's no way to know. That is uncertainty. And that is what the market is about. The market is totally about uncertainty. So risk is not volatility. It's drawdown, loss of capital. I will admit that on a short-term basis, volatility is a fairly decent proxy for risk. The more volatile it is, the more risky it is. I think that makes sense to most people. And over the long run, a drawdown is a much better measure of risk. Here's the last bear market, the blue line. It started on October 9th, 2007, and it ended in February of 2013. So that's what, 6 years, 5.5 years, where if you were a buy and hold, assuming no inflation and no dividends, et cetera, you rode that blue line all the way down, and you rode it all the way back up to where it was when it started. 6 years later, you had no gains in your portfolio, and you're now 6 years older. What if you were living in your retirement assets and you were withdrawing 6% a year, and let's adjust this for inflation, just 3%, we adjust it quarterly. That's the red line. So you ride this bear market down all the way, a little bit further, because during that time you're pulling money out, and then look what happens. You're toast. You never get back to even. You just waddle along there. You've lost 50% of your retirement money. You're still pulling out the money. You still have inflation to deal with. You still have expenses, and you're probably going to go be a Walmart greeter somewhere. This is how alpha and beta is calculated. This is a linear least squares fit on some data comparing a mutual fund against an index. This one's called ABC, and this one is fairly correlated. You can see R squared is 0.79 Modern finance likes to use R squared instead of R, which is correlation. Now here's another equity where the returns compared to the index are scattered all over the place. However, that least squares fit, which is a mathematical way of representing all that data with a linear line, has the exact same equation as the previous one, yet the correlation is very low. So here's the overlay of the two. The same line represents the red dots. It also represents the blue dots. And so when you're going into Morningstar or one of these firms that shows you all these mutual funds, and they show you, oh, the alpha is where it crossed the y-axis, and then the beta is the slope. That's alpha and beta. That's where it comes from, those simple mathematical statistics. So if you go into Morningstar and you're looking at mutual funds and they're showing you the alpha and the beta, guess what they won't show you? They won't show you the correlation. And if you don't know what the correlation is, alpha and beta are totally meaningless, as I could show you there, because that blue fund had the same comfortable returns as the red fund, and one of them was, and they were both, one was highly correlated, the other was not. I think that concludes my presentation for today, Tom and Aaron.
All right. Let's see. I know I did have at least one question in the chat room for you. It was very early on. I think it actually came in.
Well, I think they're probably all gone now.
The question is, do you prefer value or growth in 2019?
Oh,
pretty general.
Well, it is, and it's. I would hesitate to offer an answer there because it's been so long since I've thought along those lines. I would probably always prefer growth because I'm a trend follower, because growth will tend to do better as a trend follower than value. But like I said, I just follow a technical model so that I don't have to answer questions like that. I'm sorry that wasn't the right answer. That wasn't an answer you expected, but I'm trying to be honest about it.
Yep, it is what it is going into 2019. That is for sure.
Yes.
It'll be very interesting.
I do have opinions, not based on anything other than 45 years of watching this stuff. I would be surprised if 2019 year wasn't a tough year.
Yeah.
Could it be a bear market? I don't know, but I think it's just going to be a tough year. 2018 was a fairly tough year. Started out wild and crazy, and then had about 6 months of uptrends, and then wild and crazy at the end. Buy and hold got hurt. Trend following was difficult. Most forms of analysis were difficult.
All right. Well, I think this slide you definitely need to go over before we go.
Okay. Well, that's, everybody, I read all these books. Everybody has rules. And I said, well, I'll come up with some. Turn the television off. Stop surfing the internet for advice. Develop a simple process, one you can explain to anyone, minus trend following. Have a process for selecting securities for your trend following model. I use momentum. I like things. If it's going up, I'll buy it. If it's not going up, I'm not going to guess. Devise a simple set of reasonable rules and guidelines. These are the rules that you must have the discipline to follow. Follow your process with discipline. Without it, you will fail. It's just that simple. Discipline is the whole secret to any type of strategy. I don't care what it is. And I say, if you don't have the discipline, find somebody that can do it for you. Don't be upset with yourself if you don't have that discipline. I tried trading commodities back in the 80s. I did not have the discipline. It cost me a lot of money to learn that lesson. And don't confuse luck with skill. Listen and learn from the market. It's always right. And so I couldn't come up with 10. So I said, read this list often.
All right. Always a pleasure to have you, Greg. We look forward to having you back soon.
Thanks, Tom and Aaron. It's a pleasure. Bye.